Okay, see everyone jumping on here. Very good to see. My name is Aaron Fragnito, co-founder of People's Capital Group, and we'll be talking tonight about a new investment opportunity here. I see Seth is jumping on, my business partner, the other half of People's Capital Group. How are we doing tonight, Seth?
Doing good. Doing good. Thank you. How are
Ex
you?
Excellent. Okay, very good. So yeah, Seth and I are going to speak tonight about a new opportunity we're excited to present to our investor base. It's been very well received from our initial Whisper campaign and marketing out to our investors. We've in fact have a couple of large scale clients jump into this one and fill up most of the positions available. And then we started marketing out to our retail investors. We've had a lot of interest there as well. So very attractive deal. We'll break into the details tonight. First, we're going to speak about some of our past performance and a little bit of what we're seeing in the market as well, and why we think multifamily here, especially in northern New Jersey, is a great investment. So we'll move kind of quickly through that part. If you were on our webinar from a couple weeks prior, you'll see some of the same information, but then we'll get into the details of the investment towards the second half of the presentation here. Now, if you have any questions as we go along, please type them in the chat here or in the Q&A. We should be able to answer all the questions here at the end. We'll get through the presentation here pretty quickly. It'll be about a 45-minute presentation, and we'll open up for questions. All right, let's get into it here. So this is a presentation for the PCG Fund 4 and the PCG GP Fund. This is a Regulation 506C, Regulation D 506C for accredited investors only. All right. Quick disclaimer, this investment, as I said earlier, it's for accredited investors only. That means a net worth of $1 million, not including your primary residence, or an income of $200,000 individually, or $300,000 including your spouse. If you're not an accredited investor, or you're just not sure where you fall, schedule a call with a member of our team, and we can help you determine if you qualify for this investment. We'll dig into the executive summary tonight. We'll do a little overview of People's Capital Group. We'll go over our investment thesis and talk about the North Jersey real estate market briefly. Do a couple case studies just to talk about our past performance here. We're actually exiting some properties, which will be very nice for our investors here. And we'll talk about our current portfolio highlights, and then really dig into the investment opportunity here as well, which is in Hackensack, New Jersey, bordering the #1 hospital in New Jersey. So the property we're buying next here is 275 Beach Street in Hackensack, New Jersey. And actually what we love about this property is behind it is the Hackensack Meridian Health Center, Hackensack University Hospital, and across the street is the Hackensack High School. By the way, if you have any technical issues as we go along, please let me know as well in the chat. Hopefully you can see and hear us fine. So Seth and I have been operating People's Capital Group for about 11 years now. We incorporated our company in 2013. We focus strictly on the North Jersey market, primarily repositioning Class C buildings into Class B, which is exactly what this next opportunity is. And we focus on multifamily and mixed-use buildings. Together in New Jersey, Seth and I have completed about 279 transactions. We have an 83% investor retention rate. That means over 8 out of 10 investors reinvest after a liquidity event. We work with about 100 investors, mostly high net worth individuals, and a few family offices in there as well. Family offices and high net worth family, generally a net worth of 250 million or greater. Little background on us here, just under $40 million in assets. So this next one will put us up to about 65 million in assets under management. 98% of our transactions are in New Jersey here, about 191 apartments owned. Currently, we buy and sell apartment buildings throughout New Jersey. And we're vertically integrated with the real estate investment firm here, Real Estate Investment Property Management in-house. So we manage all of our buildings with our in-house property management company. We have about 12 members on our team, 30 years of combined experience between Seth and I here in real estate. We've completed 11 syndications, raised a little over $18 million in capital, and returned over $8 million in capital to limited partners. And Seth, why don't you talk for a second here about our current portfolio highlights, which you focus on working with a management company on?
Yeah, sure. Yeah, so when Aaron and I started this company to invest in real estate, we had a goal of getting basically to 1,000 units, 1,000 doors, and to get really rich really fast. And we realized that to buy a lot of units, you need a lot of cash. And at some point, I think when we hit about 100 units back in 2014 or 15, we realized that we ran out of cash. And so we figured the next best thing would be to help other people who are like-minded with us to grow their real estate wealth along with us and leverage their idle cash if they have the same values and goals as us. So we've been doing that over the last 10 years. We've sold a lot of properties through the years. Looking back, the values have gone up so much, we really should have kept more. But we currently have about 32 properties, 191 units, and we're scaling now. So about half of those are just myself and Aaron, and the other half are with our investors. And we're helping everybody build wealth together. So the management, as Aaron said, is all done in-house as well. We did test out the model of outsourcing the management back in 2015 and quickly realized it's not as efficient as managing it yourself. So we are right now occupancy rates of 99%. Collections are about the same, sometimes even more because we're on a cash basis as opposed to accrual. And when you factor in late fees and other fees, sometimes you can actually get over 100%. And we've done that many times. Average cost per door over the years, 131,000. Average rental rate right now, 1527. It's gone up about 50% since COVID, at least for our units. And the average realized sale per door, 226.
Excellent. All right, Seth, if you want to maybe dig into this next slide here too, that'd be great.
Yeah, sure. So, yeah, so basically, again, to achieve our own goals, we want to find like-minded individuals who have a goal to build their wealth and preserve their wealth through real estate. A lot of our clients, before they become clients, are heavily invested in stocks or cash, maybe gold, and they have a hard time getting into real estate and diversifying a portfolio into real estate. We usually suggest about 25 to 50% is a good number. Aaron and I are a little more than that. We're over 50%, but this is what we do. But yeah, so we've created a fund here, the latest fund, PCG Fund 4, to help individuals and groups that qualify to come into the next opportunity. It's a 78-unit property in Hackensack, as Aaron said. And to get to this point, it takes, we kind of bring all of our skills to the table over the last 10, 12 years. So we're generating, deals through relationships with realtors. We're getting oftentimes off-market deals like this property in Hackensack. And so we're sourcing good deals. We're looking at many deals to find, to find a good one. And then we underwrite it at a very high professional level. We usually bring in professionals from New York, usually from UBS. And we get a very good basis of value for the property. And then we can create projections for the investors, targeted returns as well. And as Aaron also mentioned, we're vertically integrated. So we have all that in-house along with the management, and we can keep a tight grip on operations and extract maximum efficiencies out of each property by operating in-house and not having to rely on an outside management company. And again, our team goes about 12 people deep. And then we have a lot of outside contractors as well, all sort of centrally located around the properties. So we can move very quickly when there's a problem and solve problems. And that's what the business is all about, is solving problems, and how well you solve problems is how well you're going to succeed. So we're vertically integrated. We can solve problems. We're lean and mean. We're always looking to become better, faster, and more efficient. And it never stops. There's always ways to improve. So that being said, we also know it's sort of at the end there, it says investor first approach. So we're only going to be as successful as we make our investors. As Aaron mentioned, we have over 100 different investors through the years, mostly repeat investors. I think it's 81% repeat rate. And we're only going to be as successful as we make them. So we put them first. And it's not just talk, it's how we operate. And it's been working well so far, but we're opening the door, it looks like, to new investors as we grow. And ideally, we can help more people invest.
Thanks, Seth. All right, we'll dig into a quick overview here of our strategy with our investments. So when we underwrite a deal, we, put our investors first. We look for the best IRR to investors. We structure the deal to create the highest return on investment for our investment partners. First of all, we want to make sure we have a preservation of capital. We rigorously stress test deals, assume worst case scenario, most likely case scenario, and best case scenario to make sure we understand the risks of each investment. We structure the deals to have a return of capital that's through a refinance generally, and this deal will refinance it target of end of year 3 to return about 30% or so of investors' capital with cash flow starting on day 1 as well. And return on investment, which is produced through cash flow on the property. We'll target about 5 to 7% annualized cash flow on this investment starting from day 1. And then the main return investment is realized upon the sale of the property, where we are targeting about another 160 or so percent return to investors. So in total, about a 2.2x equity multiple on this upcoming opportunity. Average rent roll increase per year, about 8.6. So we focus on renovating the apartments, leasing them out to quality tenants, increasing that revenue on the building. And when you increase the net operating income on an apartment building, it increases the value. And then we harvest that value that we create through refinance and sale over time. Our average annualized cash on cash return then to investors is 15.1 with 11 syndications and an 83% investor retention rate. So we'll look at 100 deals or more to buy one. Right now, we do see very good deal flow. We have this deal we're acquiring, and we're very close on a few others. But right now, this is a great deal, one of the best deals that we have in our ecosystem right now. Out of 100 deals, about 30 will undergo serious due diligence. That's sending it up to our underwriting team, which puts together a very in-depth Excel model. This is institutional level underwriting, and that's how we source capital from institutional levels like family offices and pref equity companies. And then we go in and submit about 10 to 20 LOIs. Out of that, we'll expect to get one deal out of 20 offers. So it is a numbers game. If there's any active investors on the webinar here, you know how hard it is to find a discounted apartment building for sale in a high demand location here in northern New Jersey. There's a lot of competition, and you have to know the right brokers to source off market deals and make a lot of offers. That's what we do, especially because we're very conservative with our underwriting. So our offers often won't compete with general market offers. So we want to be the only bidder on the table to be able to actually get these deals under contract. But it is certainly a numbers game. Once we put the due diligence together and put the property under contract, we create a data room with all the offering documents and the full set of due diligence information. That's in our deal room. You can have access to that if you access our investor portal, where you can access the underwriting and all the details of the investment, our rent study that's completed by very experienced leasing agents, and all the due diligence, the resale due diligence, and so on, to make sure we're very transparent in our due diligence process and our specialist studies like the inspections and so on as they become available. Then after we put the property under contract, we get our subscription agreements together. That's the private placement memorandum and the actual documents giving our investors actual legal ownership in the opportunity, along with the proper wire instructions to complete their investment. So the first step is the soft reserve, which investors are completing now. We're about 92% filled on this one. So if you haven't completed your soft reserve, you'll want to get into our investor portal and do your due diligence and complete that soft reserve pretty quickly. We expect the spots to fill up over the next couple weeks. Then our PPM should be ready actually next week. We're moving pretty quickly on this one, and we'll have about a 30-day period where individuals who completed the soft reserve will be required to complete the e-docs and then wire the investment to the account, which, by the way, is held in the PNC money market account, which actually earns a decent interest rate these days in the high 3s. And that interest is distributed to investors as it sits there prior to closing. It's a quarterly distribution on that interest earned. So the money doesn't just sit there and do nothing as we go through our 75 to 90-day closing process. It earns interest. It's in a money market account with PNC. And then once we close, we do quarterly cash distributions. Again, we'll expect cash flow from day 1 on this investment, starting around 5% per year. monthly and quarterly updates. If you are invested in our deals, I take pride in our monthly updates. I try to really put a lot of in-depth information in there. The challenges we're facing, the solutions to those challenges, good news, bad news, and everything in between. And be completely transparent, and that's also accompanied by a rent collection report every month, and then quarterly financials. The quarterly financials are going to include a balance sheet, profit and loss statement, and a distribution statement showing the distribution completed that quarter to investors in that property. Every year we complete the annual K1, which is done for you and then uploaded into the investor portal. By the way, we expect a 25% tax write-off on this investment. So if you have passive gains in 2025 and you want to write them off, this is a great way to do that. For example, a $100,000 investment in this opportunity, you'd expect about a $25,000 tax write-off, a passive tax write-off on this investment to write off your 2025 gains. If you want more information about that, you can schedule a call with our team and understand what that really means for your taxes. And also your CPA can connect with our CPA to make sure the tax strategy is a fit here. We also accept self-directed IRA capital as well. About 30% of our investors use a self-directed retirement account. Here's our management flow chart. Seth, why don't I just pass this off to you here, and you could talk a little bit about the structure of our company, since you're a little more on the operations side and making sure the trains run on time, as we say.
Yeah, certainly. Yeah, so as I say, it's always our motto to become better, faster, more efficient. It never ends. There's always somebody out there trying to eat our lunch and doing things maybe better than us, or trying to do things better than us. So we're trying to set up our management in such a way that we can operate optimally and be the most efficient company out there. So this is subject to change. Just a little disclaimer, right? But as it stands now, yeah, we have Aaron and myself who founded the company, and then we have several different departments. We've got the sort of the deal analysis with the underwriting team, Matt, Shani. Then we have a marketing team of 4 people. They're listed here as well. And another department is the property management, and then the capital management. So 4 different departments. Property management has been around the longest. We established that in 2015, and it was with Lena. So she's been with us a long time. And we've since brought on Diego and Melanie through the years. And then in capital management, we have our CPA, Robert, and our in-house bookkeeping with Dana. And together with myself and Aaron, we collaborate really on all 4 departments throughout the day and throughout the week, always trying to find, optimal ways to do things.
Excellent. All right. And Seth, why don't you take this one as well here?
Sure. Yeah, so Aaron, as you mentioned earlier, we have 30 plus years of combined experience. Prior to founding this company, Aaron was in college. I was in New York in a healthcare business for about 8 years, and we sold it in 2009. And then I decided to get into real estate at that point. And Aaron and I had like minds, like goals, and we established this company. And yeah, we have 2 different functions basically. So Aaron is more investor relations, brings 10 plus years of real estate, started out as a realtor, a respected figure in the New Jersey real estate market, and sort of a confidant to our investors, our clients. A lot of our clients will reach out to Aaron before they make a big financial decision in life. Not every time, but we want to be there for them when they're ready to make a decision, and help them do that if we need to. And Aaron also hosts a podcast called the Passive Cash Flow Podcast, New Jersey Real Estate Network, which meets twice a year. And then we have an end of year celebration for our clients, sort of a private event the 3rd time. Aaron also is an adjunct professor at Rowan University. And myself, like I said, I got into real estate in about 2010, and have done about, together with Aaron, about 300 transactions. We have a portfolio of over $40 million. And I do focus on the management and strategy. And yeah, always looking to get better here. So it's a constantly improving process.
Thanks, Seth. Yeah, absolutely. We have about 180 episodes of the Passive Cash Flow Podcast. Over 200 videos on YouTube as well. You can check us out there, People's Capital Group on YouTube or the Passive Cash Flow podcast on any of the major podcast platforms and YouTube. We do in-person events. Our next in-person event is June 25th at the Jersey Cyclone Brewery in Somerset, New Jersey. You should have gotten an email to that if you're on our email list. If you haven't, you can reach out to us and we'll send you the link to sign up for that event. We get about 60 to 70 investors and service providers and real estate specialists and people brand new to real estate as well out to those events. So we do that twice a year. We do one in Somerset, New Jersey in June, and we do a kind of a kickoff the year event in January in Jersey City at the 902 Brewing Company. And then twice a year, we also do an investor walkthrough. So generally in the spring, I'll do a walkthrough of a building we recently purchased. I did that with the 42 unit we just bought in Passaic, New Jersey, beginning of May. That was a nice event where we teach investors about how we reposition these buildings, and we kind of show them the process in action there. The contractors actually doing the work and so on, and talk about how we increase the NOI on these properties and the why behind it too, not just the how. So we'll do another one of those building walkthrough, probably this building that we're buying right now in Hackensack. We'll do a walkthrough probably in October. And then at the end of the year, we do a November event for clients only. That's a nice dinner we do usually in the Somerville area here where our office is. We have ebooks and a lot more information on our website, peoplescapitalgroup.com. We have about 5,000 members in our group called New Jersey Real Estate Network. So, Seth and I have been really building this brand for a long time here in New Jersey, and just educating people on how to build their wealth and preserve their wealth in real estate. We don't sell education. It's all free. We just help people actually invest successfully in real estate. And I did teach one semester as an adjunct professor. I wrote and taught the course Real Estate Entrepreneurship at Rowan University. It was a great experience, but a lot of work, and definitely something that I only had time to do for one semester. But now they have the course, so they can enjoy that. All right, I'm going to dig here into a couple notes on the market in New Jersey, and then we're going to dig into the actual offering here that we're buying here in Hackensack, New Jersey. So, most indicators focus on markets outside of New Jersey, red states such as, Texas, the Carolinas, Florida. And we want to offer investors something different. First of all, our business is here. We know this market. We have strong relationships that are priceless, that source great discounted deals for sale. But there's also an inherent need for housing here in New Jersey, an insatiable demand for housing and a shortage of housing. These properties produce cash flow as rental values have grown through the years. There's declining homeownership rates and single family starts. We're about to find that, we haven't been building enough real estate. There was a big boom during COVID of new construction of real estate. That's been hitting the market over the last 2 years to 4 years, and that's been saturated now. And we have not been building enough real estate because it's been expensive to build new real estate as interest rates have increased. So I think what we're going to see in 2026 is a continued shortage of inventory, which will lead to an increase in housing costs, rental and purchase. Of course, there's tax advantages of owning real estate. Our investors should expect about a 25% tax write-off in 2025 from this current investment opportunity. Capital appreciation is great, especially with our forced appreciation of buying at a discounted price, renovating units, leasing them out for fair market dollar, and then improving the asset operations to increase the NOI. And if you're owning real estate within an hour of Manhattan in the North Jersey market, as we do, it's a pretty sure bet that over time, real estate values go up as well over a long enough period of time. And we try to be conservative when underwriting these, but that is part of the benefits of owning real estate in this high demand North Jersey market. Supply and demand imbalance, as I was saying, there's not enough houses for as many people need housing here in Jersey. Hard assets, tangible assets, you can insure against loss with real estate, which is one of the things I love. I invested in cryptocurrency and lost 90% of my investment, and you can't insure against loss with these other investments like crypto and stock. Not to say you shouldn't own any, but real estate is in some ways more risk adverse. Favorable market pricing with what we buy these properties for off market, and good demographics here, strong income, lots of jobs, good schools, and Jersey is often an overlooked market that we take full advantage of here, have for many years. So the average monthly multifamily rent versus the new home mortgage payment. So what we're seeing right now is the cost to own a home is much more than renting. And if you've tried to buy a home or, and stop renting and buy a home anytime in the last 2 years here in New Jersey, you've seen that. And what this is creating is a generation of renters, people that kind of thrown in the towel on home ownership. And it is a shame, but it means that we have longer term, high quality tenants in our units because there's such a delta between the cost to own a home, which is very expensive, and the cost to rent, which is actually still somewhat affordable here in North Jersey. But you can see on this chart, there's a huge delta between those two costs. And the average monthly multifamily rent versus the new home mortgage payment in New Jersey, again, same idea here. It is far more expensive to own than rent. So a lot of people are just renting long term, and those are good quality renters with good jobs. The inventory here in New Jersey, you could see over the last 4 quarters, we've created 16,838 units. We have an absorption rate of 19,637. So we're about 3,000 units short. That means we're absorbing units faster than we can build them here in New Jersey. And that's not going to improve over the next couple years because housing starts have slowed down dramatically in the last 2 to 3 years as rates have increased. And that means we're going to see less units hitting the market. We saw a good amount of units hitting the market because the COVID development boom when rates were low and real estate was booming and developments were getting started more frequently. And then that slowed down as rates increased over the last 2.5, 3 years. So you're going to see a continued shortage of housing. We already have 3,000 units short over the last year, and we should expect that to increase. Effective rent is going up 3% year over year. Occupancy, one of the strongest markets for occupancy is North Jersey. It's up 60 bips year over year. Employment is up 1.1% year over year as well. Strong jobs here, high paying jobs, lots of good businesses here to work for in northern New Jersey. And households are up despite what you might read in the media or whatnot. New Jersey is growing in households. We are not shrinking, especially some of these high demand markets like Jersey City, Bergen County, where this building in Hackensack, New Jersey is located. Newark, we see a lot of opportunity in Newark. In fact, we're very close on buying a Class A building there in the next few months. So we're seeing households grow in New Jersey. There's not a net migration out of New Jersey. In fact, it's quite the contrary. There's a net migration into New Jersey. Annual home ownership rate in New Jersey has plummeted. It basically peaked in 2004 at 70%. Now it's down just under 63%. This is because the cost of owning a home is far more expensive than renting. You can see the national home ownership rate is around 65% or just over 65, more around 66, and we are below that. So more people rent in New Jersey than own because New Jersey is one of the more expensive states to own a home in, so people just settle for renting. And here's the 2025 forecast supply growth by metro. The bottom line is New Jersey is not one of the cities here that is being oversupplied with real estate. People say, why do you invest in a blue state? Well, here's why. Because it is hard to develop in a blue state. There's more red tape in a blue state. What does that mean? That means that it's harder to build a bunch of inventory and oversupply the market. That's an insurance policy that our real estate should maintain its value because and the less likelihood that the market will be oversaturated than some of these red markets where it's much easier to develop. So it's a double-edged sword, right? If you invest in a market that's very easy to develop, you're likely to have oversaturation where, if you look at this list, 9 out of 10 of them are, red states. So that's the issue. When it's easy to develop, you have oversaturation in those markets. We don't see that here in Jersey. A quick note here, this is from Rent Cafe, the 2024 U.S. rental market. North Jersey is number 3. Right? It's the number 3 rental market in the country. Just a very strong rental market, often overlooked, but really ranks very, very well. People want to live within an hour commute to Manhattan. There is a lot of people actually moving out of the city into New Jersey. Jersey City is now called the 6th borough of New York City. And, if you see what's going on there, you can understand why. And that migration continues into Bergen County and cities like Hackensack, where we're buying this next opportunity. Real quick, we're going to jump into a couple properties we're turning over here for investors. This is a 11 unit in Paterson, New Jersey. We're actually selling now. We refinanced it 2 years in, which was about 3 years ahead of schedule. We returned about almost half of investors' capital 2 years into this investment through refinance. And then now we're going to sell the asset as well, where we target about a 20% overall annualized cash on cash return to investors on this property here in Paterson, New Jersey. So same strategy, buy it for discounted price, renovate units, lease them up for fair market dollar, harvest that equity growth with a refinance, and then sell a few years later to have a final liquidity event and cash flow along the way. So rinse and repeat, same strategy here, North Jersey properties. Here's another one in Passaic, New Jersey. We refinanced this successfully, hitting above target to investors, getting a nice repayment of the capital about 3 years into the project, just under 14% annualized cash and cash return from the refinance. And then we went to sell the property, achieving slightly above target here, just over 5 years into the investment, about 11.7 annualized cash and cash return to investors. Selling this in a bit of a down market, taking into account here, and still doing quite well. So, you stress test these deals. You say, well, we bought this in 2020, and we bought it June of 2020. We sold it August of 24. I mean, the market was great when we bought it. We bought it at a time where market was just about to take off, really, and got it for a great price. And now selling it here 5 years later. So we actually bought it in June of 2019. Selling it 5 years later, here we sold it in a down market, right? That's a good example of buying in a bit of a hot market and selling in a down market and still achieving target returns to investors, because we stress test these deals. We assume markets are going to fluctuate, and they do. Right now, it's a good time to buy commercial real estate. This isn't going to last forever, but it's a good time to buy right now. Where 4 years ago, looking back, it was a good time to buy if you exited in like 2 years later, right? But it was a very hot market and not a great time necessarily to get deals at discounted prices. Now we can get deals at discounted prices, and that's why we are buying real estate more aggressively, because prices are down. It's a great time to buy. You want to buy low and sell high. So we recently purchased a 42 unit here in Passaic, New Jersey. We've distributed $42,000 to investors on this property since purchase. We bought this in December of 2024. So we've owned it about 6 months. We've already done 2 distributions, equating over 42 grand to investors. Same strategy on this investment. We bought it for a good price. We're going to put a little over $1 million into this asset. We're targeting a 20% IRR to investors, similar to the Hackensack property we're buying, which is actually about 15 minutes from this building. This is 42 apartments, targeting about 2x equity multiple, 5-year investment period. We'll aim to refinance just beginning of year 4 on this investment, return about 80% of investors' capital on this deal at the refinance, and then go to sell, creating a final liquidity event, targeting about a 2x equity multiple on this investment over a 5-year period. Here's another building we bought in Bayonne, New Jersey. It's a good example of a building we ran into challenges on. We bought this kind of at the height of the market, 2023, very beginning of 23, right? Not a great time to buy real estate. Prices were high, rates were starting to really get up there as well. But there's a lot of value add to this property, and we ran into issues with the town holding us up. However, again, we stress tested the deal. We bought it at a decent price, and we stayed on budget here with our renovations. And we've increased the rent roll 16% over the last 2 years or so that we've owned the asset. And we'll probably end up selling this asset in about 1 to 2 years from now. And through sale, we should be able to achieve our target annualized cash and cash return to investors. Same strategy here. We'll refinance or sell after a 3 to 5 year period. And this is a nice one there in Avenue C in Bayonne, New Jersey. We've already repositioned about 60% of this asset in the first just over 2 years of ownership. Here's another building we're actually selling. It's a 25 unit in Paterson, New Jersey. We'll be selling this. We just signed a a contract, or we're about to sign a contract. We just agreed to an offer from a buyer at our strike price. So we're going to sell this now over the next 60 days to this 1031 buyer. Actually, he came in at a pretty strong offer and he needs to close quickly. So our favorite types of buyers. So we bought this in 2020. We're selling it now. It will be just under 5 years by the time we sell the asset. And we should achieve target returns to investors of around 12% annualized cash on cash return on this deal here. This was actually an old factory that was converted into condos, and we bought then 25 out of 31 condos in this complex. Improved the management of them, improved the rent roll over time. Ended up putting more than that renovation budget we targeted initially into the building, and now we'll sell the building to complete the final liquidity event on this property. Here's a 27-unit complex in Rahway, New Jersey. This is actually a boarding house we purchased right near the Rahway train station. By the way, Rahway is a great market, nice downtown area, a lot going on there. We really love Rahway. Big renovation budget on this one. We are on budget. We are a little ahead of target, actually. We're converting this into apartments, zoning wise. We've renovated all the units to put kitchens inside them. Boarding houses are unattractive to appraisers and lenders. If you can convert a boarding house into an apartment building, you can build value into the asset very successfully. And that's what we're doing on this building. Not only do you get better quality tenants, a higher rent roll with nicer units, but you also get higher appraisal values and higher resale values. We don't want to sell this building. We love this location and it cash flows very well. So we've increased the rent roll on it by 67% since acquisition. We expect to refinance end of 26 on this. We have a nice low interest rate locked in until the end of 26. So we're just enjoying that cash flow to our investors right now. And one of our favorite assets here in Rahway, New Jersey. And here's our heat map. Most of our activity has been actually in Newark, New Jersey. 99% in northern New Jersey there. About 200 transactions in Essex County. We've done very well in Essex, Bergen as well. And mostly that kind of northeastern corridor there of New Jersey. Generally, a 1-hour commute to Manhattan is our specialty. And again, about 279 transactions completed by Seth and I here in New Jersey over the last decade plus by people. Jersey. This is our next acquisition. We are under contract to purchase this building for a discounted price. It's your classic Class C building in need of repositioning. We're going to renovate it, the units, put laundry in the units, and lease them up for fair market dollar, and reposition this asset into from a Class C into a Class B building. So there's lots of things you can change about real estate. You can change the finishings in the kitchens and the bathrooms. You could put in recessed lighting. You can redo the floors. You can put laundry in the units. You can improve the amenities in the building, exterior, interior, and we're going to do all of that. What you cannot change about real estate is the location. So when you go to buy real estate, as the old saying goes, location, 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 which is 100% true. And with this building, what you see here in the bottom left corner is the #1 hospital in New Jersey, right? The Hackensack University Health Center, Meridian Health Center. So, and then behind us, from where this picture was taken, is the Hackensack High School. So this building, literally behind it, behind the parking lot, borders the #1 hospital, and then on the other side is the high school. So we love the location. It's 2 buildings, 39 units in each one, all apartments, no retail, and they're your classic, Class C building, 95% occupied, rents 50% below market value, outdated units. Everything works fine. The heat works, the plumbing works, the roof works. There's no issues with the building. It's a fully running and occupied building, but the units are outdated. It's got a nice big parking lot in the back, 75 spaces. And it's in need of renovation. So we'll put about $2.1 million into this building throughout the interior of the units, the common area, the exterior, and that should allow us to lease the units up for about we're underwriting it at $2,300 for for one beds and 2,700 for two beds, but our leasing specialist actually targeted about $50 higher than that. It doesn't sound like a lot, but if you lease units for $50 more than you underwrite, that actually makes a very big difference on your total returns, because it's just icing on the cake, as they say. You cover your costs with a certain income on the property, and everything above that is just straight profit. So as we increase that rent roll, we increase the revenue in the building, we increase the value of the building exponentially. So we underwrite it at a lower rent than our leasing specialist is targeting, and hopefully we can acquire lease those units there for that higher rent amount. But even if we can't, we still have it underwritten at a conservative amount. There you can see the hospital. It takes up this whole area here. In the rear, it's actually like a 3-block campus. If you ever been there, hopefully, for the possibly the wrong reason. That's why we go to a hospital, of course. But many people I've talked to have been there for different reasons, and it's really a great hospital. #1 hospital in New Jersey, voted by U.S. News for like the last 4 years. The Merding Health Center there, so the Hackensack Hospital. And in the high school course, great place for families, teachers. And what these two resources offer is a consistent flow of decent paying jobs, right? People that work at the hospital, work at the high school, and want to live near their place of work, or families that want to live near the high school as well. So obviously huge employment hubs, both of these, and good, well-paying jobs, right? Of those types of tenants we're looking to attract, that kind of $80,000 to $120,000 income. That's going to really like a nice renovated unit with quartz countertops, recessed lighting, freshly done floors, new kitchens and baths, laundry in the unit. And yes, the building is a little bit older. No, we're never going to really compete with Class A brand new real estate. But guess what? Our $2,300 a month unit, when you're in it, isn't going to be all that different than a lot of the Class A real estate that's being built up in the area. But the price is going to be a lot different, because if you want to live in a Class A brand new building, it's going to be more around $2,800 to $3,000 for that one bedroom, where ours will be $2,300, and you'll have a lot of the same finishings in the unit. Okay, now we're not going to have a gym in our building, or a spa, or a pool. But a lot of people don't want to pay the extra money for that, and quite frankly can't afford the $3,000 a month one bedroom. So we're looking for that middle class tenant that works at a hospital, works at a high school, and that's a perfect fit for what we're going to be. The types of individuals will be looking to move into our units. They're quality tenants with decent paying jobs. Here you can see the proximity to New York City, the greatest city in the world, some say. And we're about a 12-minute drive, 8 miles in, 28 minutes by bus, 38 minutes by rail. Here's the Newark Airport. I'd say less people say the greatest airport in the world, although I fly out of Newark all the time. I actually really like it. But a very popular hub there, international airport as well. And there's our target property, Beach Street, close to obviously a huge metropolitan city there, New York City. So as I was saying, rents are 50% below market value. That's the locations what we love most about this, and the value add strategy. Limited inventory in general in New Jersey and Hackensack as well, with a shortage of affordable housing. Now, when I say affordable housing, I don't mean low income housing that's zoning restricted. I mean housing that is of quality, but affordable. Right? Not a $3,000 one bedroom, or a $4,000 one bedroom like you see in Jersey City now, or a $5,000 one bedroom like you see in New York City, right? These are more affordable units that the average school teacher or nurse can afford, and that's what makes this building attractive. So we work to create workforce housing for our communities here in northern New Jersey. And that's what this building is going to allow for as we renovate these units, give it the finishings and the amenities tenants are looking for in this price range, and bring these to market. We target cash flow from day one. That's 5% in years 1, 2, and 3. And then we're targeting a 6% year 4, 7% year 5 as we exit then the asset through sale. We're targeting a refinance. We're going to buy this property using bridge debt with smart leverage to leverage our investors' capital wisely and conservatively as well. This will allow us to create stronger returns, target percent of about 20% IRR on this investment. That's about a 2.2x equity multiple over the life of the investment. We're talking about a 30% return of capital end of year 3 through the refinance, and about 160% or so return of capital upon the sale here. You can see the two different investment categories we have for the PCG GP fund here. We'll get into in a second what that means. So as you can see, on the $100,000 investment, we're targeting 5% cash flow years 1 and 2, years 3 as well, 5% cash flow. Then we have the 30% from the refinance. Then year 4, we've repositioned the asset. We've leased the units up for fair market dollar. We've completed our renovations. We've refinanced into a low interest loan, agency debt, and that allows for stronger cash flow on the asset. And then we go to refinance, sell the asset in year 5 and cash flow through year 5 as well. We'll sell at the end of year 5 ideally. And that's where the majority of the returns are realized on these types of investments. Overall, that's about a 2.2x equity multiple, and we expect about 166% profit on the sale of the asset and cash flow from day 1. You have a minimum investment of $50,000 for the category on the left, minimum investment of $500,000 for the category for the investment option on the right. Obviously, there's an incentive for a larger investment amount. So let's talk for a second about the structure of this deal. This is important to understand, but also, it doesn't really necessarily change the experience or the target returns for investors. Those target returns I just put out there in the last slide are for the PCG GP fund, which is the fund that is available for this investment. So first of all, we have Beach Street Holdings LLC. That's the LLC that owns the property. The rent goes into Beach Street Holdings LLC. The expenses go out. Every quarter, that's ideally net profit to distribute, and that gets distributed up to PCG Fund 4 LLC. PCG Fund 4 LLC has limited partner investors as well. Those investors have already spoken for the available shares in that LLC. So PCG Fund 4 LLC is fully funded. That was taken up by 2 large investment groups. That's a testament to how good a deal this is. These very savvy investors do in-depth underwriting and like the deal enough to basically soft reserve all those shares in PCG Fund 4 LLC. Then we have PCG GP Fund LLC. So in this offering here, we are coming in on the GP side with 20% of the capital, 20% of the funds required for PCG Fund 4 LLC, which is about $720,000 or so roughly on that investment. So for that amount of, or it's about $850,000, sorry. For that amount of capital, we are raising the majority of that capital, raising about 80% of the GP investment. So this is the GP Fund LLC. The investors in PCG GP Fund LLC are limited partners. They don't have any managing responsibility. They're not signing for the debt. They're not making day-to-day decisions. Their risk is limited to their investment, just like the LPs in PCG Fund 4 LLC. The only difference is the investors in PCG GP Fund partake in the profits that are paid back up to the GPs. So ideally, earning a little bit of a stronger return on investment. The bottom line is that allows investors to partake in the GP returns in this investment. GP returns tend to be stronger. So right now we have room for, actually we just had another soft reserve today come in. So it's no longer 620. It's going to be, we had another 150 come in today. So it's, my math is off, 470, long day. I've been going since 7 a.m. here. Minimum investment, $50,000 on this investment. As you can see, I completed this presentation Tuesday night. And just today we had another 150 come in. So this one's going to fill up really quickly. We really don't have that much room left on it. So if you like the investment, you feel it's a fit for your investment goals, I would suggest you complete the soft reserve pretty much by Friday on this investment. We do expect to sell out shares by the end of the week or so on this investment opportunity. And in managing, PCG GP Fund LLC is People's Capital Group. That's, of course, owned by Seth Martinez and I, and we are the managing members of this operation. If you have more questions about the structure, about the risk profile, about the responsibilities of the LPs, which is simply, of course, to complete the investment and then accept the quarterly cash flows, review the monthly financials. Well, you don't really have to review them at all, but you should. It's good to understand what's going on in your investment. But again, the investors are 100% LP, limited partners. Their risk is limited to their investment amount. They're not responsible for day-to-day decisions, signing any debt, or doing any of the activities that GPs do. These are limited partners in a GP fund. And the fund is only buying one property. Okay, let's dig into the two share classes here. So our PCG GP fund share classes, we have the minimum investment of $500,000 for the C class. That's a 10% internal rate of return, 50-50 LP GP split. We're targeting a 21% IRR and a 2.3x equity multiple, 25% tax write-off for 2025. For the $50,000 investment share class, the minimum investment is $50,000, 8% preferred rate of return. That's based on an IRR. 46-54 LPGP split after that pref is achieved, and then it's a 20% total target IRR in that investment. That's a 2.2x equity multiple, and of course, same tax benefits, 25% tax depreciation should be expected in first year of the investments, 2025 tax write-off. Here's the capital stack. We have the bridge lender bringing in 12.6 million. We have a preferred equity group bringing in 3.15 million. We have a common equity group bringing in 3.58 million. And then we have the PCG GP funds where we're raising about 720 of that 895. And that's what's available right now. So as you can see, this is filling up pretty quickly. The final spots available is in the PCG GP fund, which we're just now announcing to our entire retail investment group. And again, we expect this to fill up probably over the next few days. Here's our target timeline to invest and close. So over the next week, we're going to have the soft reserve period. It is first come, first serve. If you don't complete your reservation in time, you'll be placed on a waiting list. June 25th, we expect to have the PPM ready. That's about a week from now. The PPM will be reviewed then. You'll have a few weeks to review the PPM and complete the investment. We're asking all investors to complete their investment by July 9th with an extension of another week for IRA investments or self-directed retirement accounts because we know those can take a little longer with the self-directed IRA custodians. But essentially, we're seeking to have all investors complete their investment by the middle of July. If the investment's not completed by then we'll start reaching out to people on the waiting list and give them a chance to get in on this investment. By July 18th, we expect to complete our due diligence, put up our full deposit and go non-refundable on the deposit. By August 18th, we expect our mortgage commitment, and around the beginning of September, we target our closing date. Interest starts being earned on the investment. So the sooner you invest, the sooner you start earning that 3.8 or so. It fluctuates to PNC money market account on that investment. So the money doesn't just sit there idle. It does earn interest, and we'll distribute that interest on a quarterly basis back to investors. Our post-closing timeline, so ideally we close beginning of September. That would allow for a small distribution of cash flow end of October. We do our cash flow distributions 30 days after the quarter ends. That gives us time to do our financials and get all of our numbers together. Then March 15th of 2026, we'll get our K1s out. If not sooner than that, that'll allow for roughly a 25% tax depreciation to write off passive gains in your 2025 tax year. October 31st, 2028, that's about 3 years into the investment. We expect to have a refinance at that point. Return about 30% of investors' capital at the refinance, cash flowing along the way up to that point as well. And then continue to cash flow into 2030, and then we'll have our final distribution through the sale of the asset, where we have the big liquidity event of over 160% return on investment, ideally upon that sale. This is a 5-year investment with 2 large liquidity events, one from refinance, one from sale, and cash flow starting day one. So at this point, we actually have 92% of the total LP capital raised since we had more investments come in today. There's a link here to schedule a call. You can also go back to the email we sent you and you can click to schedule a call there on the website we sent you with more information on the investment here. But if you have questions, if you feel like this is a fit for your investment goals, I would schedule this call sooner than later. I would try to get on our team's calendar probably for tomorrow. Then make sure your questions are answered, make sure this is a fit for your investment goals. And if you determine it is, and you want to preserve and build your wealth in real estate in this nice high demand location here in Hackensack and achieve about a 2.2x equity multiple over 5 years, then I would complete that soft reserve probably by Friday. We have 5,000 investors on our email list. We'll distribute this webinar out to them early next week. And we have a lot of investors scheduled to speak with our team today, tomorrow as well, and into Friday. So we'll probably see a flurry of investments over the next few days. And being that there's really only a handful of spots available on this one, we do expect them to fill up in the next few days. So if you want to get on this opportunity and not end up on the waiting list, I would go to the link here. I'm going to put a link in the chat that'll allow you to schedule a call with our team. And that's the best way to have your questions answered. I'll also put a link in the chat that will allow you to go to the investor portal.